Marty's going to tell us all the color on these earnings, and then you're going to tell us what to do with it, I think, Greg, because Marty won't give me any buy or sell recommendations. He intimated, I read between the lines, I think I'm supposed to hold him for a while and then start lightening up or something. Greg's going to give me numbers, ratings. No, not really, but we may get a better idea. Marty, what about these last two? Can you start with Citigroup and then tell us about Wells?
Sure. So what you're seeing is Citigroup is experiencing less capital markets bang because J.P. Morgan had a little bit more investment banking, and the trading wasn't as strong on that side. So Citigroup's not getting as much revenue. They're getting the same provision release that you saw at J.P. Morgan. Wells Fargo's just still in the turnaround story. As you're finishing this year, there's no reason for them not to put everything into this last year. Get all the problems, all the expenses, all the things behind them in 2020, and then start fresh in 2021. So this is still going to be a very noisy quarter for them. But when we look at, again, going through the outlook of where we think this is going into 2021, is the higher valued banks, like we talked about JP Morgan, those are not the places to be. You're looking for eventually Wells Fargo's turnaround. You're looking for PNC, who announced today, and looking for what they're being able to do with their acquisition. So event-driven, and then also banks that don't have the pressure that you have on the net interest margin and not going to have the credit, which are going to be regional banks like Regions Financial that we really liked last year, and that carries into this year. So maybe that gives you a little bit more ammunition, Joe.
No,
you can chew on that.
You know what? If I was an analyst, honestly, that's all I would do. I think that's what, because a lot of times you can know something inside out, and whether that, it may eventually work itself into the stock price, or it might not. So it's best to get enough information so that you can make a decision, and that's where Greg's going to come in. You've mentioned financials before, Greg. Which ones do you like? Which ones did you like today? What do you own?
Right. So let's retrace a little bit. Because I think the trade is different today than it was when we started talking about this a few months ago. This was one of my highest priorities because the group was trading at 1.1 times price to book. The historical average for the group is 1.7 times price to tangible book. And so to me, that made no sense at all. And I saw that as one of the most blaring opportunities that we had in the market, with the market basically saying that the sector was headed for ruin. And we didn't think that was the case because of the aggressive provisioning that the best players were doing. That trade is largely done. We now have the BKX almost at record highs. We have the XLF reaching a record high yesterday. So the sector catch-up trade, the reversion to the mean for the multiple trade is done. And I agree with Marty. Now it's going to be company-specific. Where Marty and I probably disagree, at least in the short term, is that I think you are seeing a tale of two cities here, right? J.P. Morgan was able to release 72 cents of reserves. Now, they had the wherewithal to do that because management acted very aggressively when not much was expected of the sector, but also because of their diversified position, using a lot of those unforeseen gains from capital markets, trading, and investment banking. I think it's still going to be a tale of two cities for the next few months. I think that investors will value and find safe harbor in those platforms that structurally are built to weather this, and that from a management perspective have made the right decisions. I don't know if we can say that for the Wells Fargos and the cities of the world. They have something to show us.
Shepard Smith here. Thanks for watching CNBC on YouTube.